Remember earlier I said that the PE ratio is a relative valuation metric. Well, this is the first reason why it is so important to investors. It's a means of valuation. In other words, an investor will use the PE ratio to determine whether a stock is cheap, fairly priced, or expensive compared to other stocks on the stock market or compared to the market as a whole. Generally, a low PE ratio is taken to mean that the stock is undervalued, and a high PE ratio is taken to mean that the stock is overvalued. However, there is no clear-cut number as it relates to the PE ratio that can be applied to all stocks. In fact, a stock with a significantly higher PE ratio might be a better bargain than one with a lower PE ratio. And we will explain this later on looking at two different examples. This is the first reason we say that investors should take the PE ratio with a grain of salt. A high PE ratio does not necessarily mean that a stock is overvalued, and a low PE ratio does not mean that a stock is actually at a bargain. The general suggestion of buying stocks with low PE ratios is somewhat incomplete in my opinion. It is more accurate to say that for two similarly sized companies operating within the same sector with similar operations, then the one with the lower PE ratio might be the better bargain. The one with the lower PE ratio is more attractively priced. I will explain this using an example. Let's say we have two companies, Company A and Company B, both with a market cap of $1 billion, so similarly sized. Let's also say that both companies are operating within the manufacturing sector, and both companies are basically growing at around 8% per year. The company with the lower PE ratio in this case will be the more attractively priced. Let's say Company A has a stock price of $10 per share and an EPS of 50 cents per share. Company's A PE ratio is 20 times earnings. Let's say Company B has a stock price of $30 per share and an EPS of $3 per share. Company's B PE ratio will be 10 times earnings. If both companies are growing at the same rate, we said earlier 8% per year, then Company B would be the better investment based on a PE ratio valuation method. Notice that Company B is still a better value for the investor despite it having the higher share price. In fact, Company A would be 2 times as expensive as Company B based on the PE ratio alone. As I said earlier, it is generally accepted that a low PE ratio is favorable and a high PE ratio is unfavorable. But this can be misleading. Let's look at an example. Let's say we had two other companies, Company X and Company Y. Both are in the technology sector. Company X has a market cap of $50 billion and is a manufacturer of computers and other handheld devices. Its stock sells for $100 per share and it reported an EPS of $12 per share in their last annual report, down from $15 per share the year before. I'll also add that analysts expect that Company X will report an EPS of $9 per share for the current year. Company X therefore has a trailing PE ratio of 8.33 times earnings and a forward PE ratio of 11.1 times earnings. Got it? Great. Company Y has a market cap of $40 billion. It's a software company and in the last 6 months has released an app that has gone viral. its stock sell for the same $100 per share, and the company reported an EPS of $3 per share in their last 10K filing. Based on the number of downloads for the company's new app and the rate of growth in those downloads, analysts expect that the company will report an earnings per share of around $5 per share for the current financial year. Company Y, therefore, has a trailing PE ratio of 33.3 times earnings and a forward PE ratio of 20 times earnings. Notice that Company Y's PE ratio is far higher than that of Company X. So why is Company Y a better buy than Company X, even though its forward PE ratio is 2 times higher than Company X and its trailing PE ratio is almost 4 times higher than that of Company Y? The reason is actually more qualitative than it is quantitative. Company X is a larger company but has been experiencing a decline in its profitability. It is possible that new entrants have entered the market and are offering similar products as Company X but at a lower price, making it harder for them to compete. Furthermore, due to the nature of Company X's business, they would have to spend a lot more in order to generate more profit. The company would have to spend a lot more if they wanted to, say, expand into a new market or to acquire a larger market share. This could further erode Company X's profitability. On the other hand, Company Y's profitability is growing. It just launched a new viral app, and advertisers will be more attracted to the company in order to show their ads to its growing number of users. Furthermore, Company Y would not have to spend as much if they wanted to, say, expand into a new market. Additionally, their marketing expense does not have to be as high, since the viral nature of the app is attracting so many new persons to the platform. Company Y would therefore have to spend significantly less money in order to generate increased profits. Based on these factors, an investor who invests in Company Y is more likely to see an increase in the value of his portfolio than if he were to invest in Company X. Okay, so earlier I said that the PE ratio can be misleading. We've just shown that a company with a higher PE ratio can actually be a more attractive investment than one with a lower PE ratio. But what does the PE ratio really tell us? Fundamentally, the PE ratio is telling us how long it would take for a company to generate all of the money that we invest in it. This, of course, is assuming that nothing changes. And of course, I'm going to demonstrate this using an example. The PE ratio tells us how many years the company would take to earn back the money that we invest in it, provided nothing changes. As an example, let's say we pay $10 per share for a stock that is earning $2 per share in annual earnings. Let's assume nothing changes. By paying $10 per share, we're paying for about 5 years of earnings. Assuming all things being equal, at the end of year 1, the company would have earned $2 per share. At the end of year 2, its total earnings would have been $4 per share. $2 from year 1 and $2 from year 2. So in total, the company would have earned $4 per share. At the end of year 3, it would be $6 per share. Year 4, $8 per share. And then at the end of year 5, we'd have earned $10 per share. This would be equal to the $10 that we had paid initially for the stock. Thus, within 5 years, the company has earned back all the money that we, the investors, had invested in it. Said another way, By paying $10 per share, we paid for 5 years worth of earnings. As an example, let's say we paid $10 per share for a stock with full year earnings of $2 per share. In this case, the PE ratio would be 5 times earnings. Or said another way, by paying $10 per share, we are paying for 5 years worth of earnings. As investors, we ideally want the company to earn back our investment within the shortest possible time. And that is why companies with lower PE ratios have historically been seen as more attractive to investors. As we've seen from the previous section, this is not always the wisest decision. Over time, investors come to understand that earnings are not constant and stock prices are even more volatile than that. Over time, investors come to understand that earnings are rarely constant and stock prices are subject to wide, sometimes irrational swings. This leads me to the final points of this video: why you want to take the PE ratio with a grain of salt. Investors ought to consider that the PE ratio is literally just a snapshot. Over any 12-month period, a stock's price can vary widely between a low and a high. The PE ratio, provided we're looking at the trailing PE ratio, could vary just as much. And in fact, any change in a company's price will also reflect a change in the PE ratio. Next, investors should consider whether they are dealing with a forward PE ratio or a trailing PE ratio, and also to look at how that value compares to other companies within the same sector and the market as a whole. Again, a company with a high PE ratio is not necessarily overvalued, and a company with a low PE ratio might very well be overvalued based on what's happening in that company and where it is potentially headed within the next 12 months. Lastly, I want to highlight that we do not calculate PE ratios for companies that report a loss, or rather, companies that have a negative earnings per share value. Mathematically, it doesn't make sense to divide the price by a negative value, which is what the earnings per share would be, and logically, a company that is making a loss is not likely to provide any useful information in terms of the calculated PE ratio. Alright, we're at the end of this video. Feel free to share it with somebody whom you think might benefit from this presentation. And if you have any thoughts, questions, or suggestions, feel free to leave them in the comments and I'll be sure to get back to you. Thanks for watching. Oh, and don't forget to subscribe to this channel for more educational content on investing, personal finance, and financial literacy. My name is Devroy Davis, wishing you all the best.